We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Peter Goodburn, founding partner of WaveTrack International. Thanks for joining me today again, Peter.
Great, Tom. Pleased to be with you.
Excellent to have you back. And the last time we spoke, you explained to us your view on the commodity supercycle that began from the Great Depression lows. So with that as the backdrop, maybe you can explain to our listeners a bit more about your commodity supercycle theory and how you see it playing out.
Well, sure, great. I think the whole supercycle theory on commodities is a bit misplaced or misunderstood to a large extent because in more recent history, commodities bottomed in the financial crisis lows and started moving up. So people start talking about a commodity supercycle from that point, rather than from the Great Depression lows from 1932. Mm-hmm. And I think it's right to make a distinction between these two concepts because a commodity supercycle, I think, conjures up the idea that commodities are going into an exponential rise for maybe decades. But whilst we've seen a good example of a run-up in commodity prices since the financial crisis lows, and they're still continuing as such, by definition, and certainly from an Elliott wave perspective, which is my methodology speciality, these movements up from financial crisis are not supercycles per se. They are part of a longer-term counter-trend correction, which is balancing out the supercycle, which in fact ended prior to the financial crisis, actually at the peaks just before it. So this is a big distinction, and I think this is an important one because when we start defining those differences, we can actually get a fairly good idea of the landscape of how commodity prices are evolving, especially in this time of rising inflation pressures, and just how far those price levels are going to go before they collapse later.
So, Peter, maybe just to drill into a little bit more some of these structures, what is the shock, pop, drop structure, and where can we see an example of it?
Okay, well, let's. I'm just going to share my screen a second, and then perhaps I can talk you through. Okay, well, this is the longest term history that we have for a commodity index. It's the original CRB cash index, which goes back to the Great Depression lows down here at $27. I have to say that this data set's been discontinued now. It actually, unfortunately, ended in January 21, just because Refinitiv, that owned the data before, passed it on to the London Stock Exchange. And for some reason, they just discontinued it last year. But it gives us a good template to understand exactly where the trends are coming from, mm-hmm. And where they're going to. In the key concept of Elliott wave, we're used to thinking in terms of trend by definition as 5 waves and counter trend as 3s. That's a clean distinction between how we identify where a trend develops and where it's going to, and some of the amplitudes we use through the usage of fib price ratios. And we've got a combination of those two things here. Certainly from the pattern perspective, which is the qualitative approach to analysis, we have a clean definition of 5 waves up from the Great Depression low. So we've got 1, 2, 3, 4, and 5. And this is the orthodox end in 2008, pre-financial crisis. This is the orthodox end to that complete cycle period of 5 waves up. So the commodity supercycle really ended at that juncture. And everything after that is a counter trend. And the counter trends basically are composed of 3 types of conditional patterns. We either go through the zigzag approach, which are composed of 3 price swings. Sometimes they're 7s and 11s strung together. Sometimes we go through horizontal corrections, and which are called flats, and other times triangles. I think in this specific case, if we now go to something real time, which is transferring to the Thomson Reuters CRB index, we're unfolding in a bit like this, which is defined actually in Elliott wave terms as a as an expanding flat. It's going to take at least another several years to complete, if not towards the end of this decade. But the shock phase, which I define as these three phases of this specific pattern, looks a bit like this. So here's the orthodox end of the commodity supercycle in 2007, 2008. Depends on which commodity we look at. Mm-hmm. The shock phase was the initial sell-off during the financial crisis. And then we go through the pop phase, which is the inflation pop specifically. And this is the second sequence, which we've labeled wave B. And traditionally, for this particular pattern, an expanding flat, the B wave actually breaks into new price territory. It actually goes beyond the peak of the preceding uptrend. In other words, the supercycle uptrend. And that is it's not an unusual event. Actually, these expanding flat patterns occur intraday and on a daily chart across a broad range of asset classes, not just commodities, pretty much every day. And the new price extreme, we haven't reached yet. I mean, we have, for example, templates like copper and oil prices, which are interesting commodities which are very much archetyped for this, which haven't yet traded above the financial crisis highs. We're a bit short. Mm-hmm. Things like copper, and I think copper's actually traded marginally above, but certainly oil hasn't gone above the old 147 highs. It fell short, obviously, in March at 130. We've got another probably 2 years of trying to get up to these conclusions. But once that's finished, the third sequence is really where the drop phase comes in. So once the inflation period, the inflation pop, as the bubbles burst, we're then going to collapse lower like this. And I originally thought that a time scale of 2024-7 might come in, but I think we're gradually getting pushed further and further out as time goes by. It seems to be taking an awful long time for the final phase of the inflation pop to finish. And here we are at the beginning of thinking back in 2016 and also at the financial crisis lows, that inflation would never rear its head. You know, we were actually moving asset prices going up a lot before then. I mean, if you take asset prices in terms of international or global stock markets, they've been going up a long time without any rise in inflation. Really, the inflation burners have only been put on since really the pandemic. Mm-hmm. You know, because up until then, inflation was kept back by the fact that there was a very healthy manufacturing hub and production system in producing things, commodities, finished products across the world. And that competitiveness really sort of put a dampener on any rising inflation prospects. Most companies would absorb price increases. If we see commodities like copper and energy prices going up, most companies would basically absorb those price costs into their equations, their manufactured end products, in order to be competitive. But after the pandemic, a lot of companies got wiped out. There's been a lot of mergers since. There's few around again. And of course, we've been told a sort of, stories like dislocation in distribution flows, which have resulted in shortages of things. And this is why prices have gone up. Also, obviously, things like Ukraine war with the Russians has been cited as being responsible for food prices going up. But quite honestly, if you go back to pre-COVID or during the lockdowns, when there was no demand at all because it was stifled, and then suddenly we are back out of lockdown and everybody wants things again, the pickup in demand for goods and services, particularly goods, was so much that the ports couldn't really respond quick enough. And if you go back and look at some of the statistics of at the ports of the West in the US, for example, near Los Angeles and so on, you'll find that there were so many ships outside waiting to queue up just to unload their goods, but there just wasn't enough services to try and unload them. Mm-hmm. So these are the bottlenecks that I think that really did occur. And they forced up pricing a lot. And here we are now in a situation where we've got rampant inflation because there's backlog going on. And we're still involved in that. But I think that this particular format, this pattern, is very simple, but it explains where we are within the commodity cycle. We're actually in a long-term shock pop drop phase, but we haven't finished the inflation pop yet. We've got another 2 or 3 years at least to do that. And if we go and look at some schematics, this next slide is an example of the inflation pop aspect here. So this is the financial crisis lows again, and we've got 3 major phases moving up as this second cycle. And commodity prices, and certainly emerging markets as well, ran up into 2011's peaks. Then they bottomed in 2016. Some commodities bottomed lower than 2016. Copper actually bottomed in 2016. Oil prices, for example, bottomed at the pandemic lows a bit later. But what they've all done since is resynchronize, and they're in this final phase up at the moment, like this. And we're still in the middle of all of it. As I've said, we've got another 2-3 years to go. If you go to the right graphic here, this is what the stock market looks like, the US stock market. We're still around this price area here. We haven't finished there moving up either. But there are very 2 distinct patterns. So when you start comparing things like stock markets moving up because of the secular bull uptrend developing from the financial crisis lows, you've got a very, very different pattern development than you're seeing, say, in commodity prices. They're synchronized, they're positively correlated, and they generally move up and down together. But because of the amplitude changes in these 2 asset classes, you get different patterns. And that's something that's very, very unique to Elliott wave. If we can make sure that we understand that distinction, we can understand how the synchronizations are flowing, but we can also recognize the different patterns. And that's really an excellent observation, because it gives us a pretty good insight to where things are at any particular juncture and where they're going to. So just to take a look at this example with the Thomson Reuters CRB index. This basic pattern is what we call an expanding flat. We've moved up from this pandemic low. We've moved up in a first sequence here. We're moving down really this year and into next a bit in a correction to this upswing. After that, I think we get the final phase of the inflation pop coming through. And that's going to push up a lot of commodity prices once we get through into next year. This year, we're in a corrective year, having seen the post-pandemic advance complete back in March, or in this case, for the CRB index in June. March, June were very important points this year. So we're in a short-term correction phase, which will last another 3 to 6 months. Once that's finished, I think by the end of the first quarter of next year, I think all of the asset classes, including commodities, will be getting ready to drive higher again. So we're going to see the next phase of the inflation pop occur. That's going to drive up prices dramatically. It's going to drive up inflation and interest rates as well. And we're going to see, a termination probably. I think the time frame is getting pushed out. So at the moment, the time frame for an expected bubble burst is probably getting somewhere between, I would imagine, something like 2027 now is my guesstimate, because it's gradually getting pushed further out. It could be shorter than that, which was my original idea, but the way things are developing, they're taking quite a long time. Even this year's corrections are taking quite a time to unfold.
So Peter, when we're thinking about all of the, let's say the fundamental drivers for this stuff, are you just looking at the cycles, or do you take into account, moves by the Federal Reserve? How do you base these forecasts?
Well, of course, Elliott wave is purely a model of price development, which is recurring patterns. So we get this idea that patterns are recurring all the time. In the Elliott model, they're not recurring randomly, which is, but they're actually in a sequencing process. Once one pattern finishes, the next patterns emerge. And that gives you an idea of the way in which the interaction between progress and regress occurs, action and reaction processes. But the patterns are very specific, so they're not occurring randomly. There's a seamless process of pattern development. How that fits around the fundamentals is quite interesting because, you know, over my career, which spans, you know, at least 3.5 decades doing this, I've seen developments where if you take the Elliott process and apply it, you can actually forecast future events. And we've done that so many times over that last 3.5 decade period. We can take a good example of of asset prices coming into completion in 2000, when the dot-com bubble was at its height. And we said, well, this pattern is completing. It dates back to the 1980s. We're going to see a major asset fallout here, which we did, of course. And then we had circumstances like 9/11. Now, we don't have a crystal ball to actually look through and say, well, 9/11, Twin Towers, and all of this is going to develop. All we do know is that we can actually say, no, there's going to be some changes in development, which is going to pull asset prices down. And we might say, well, could that be something to do with geopolitical risk? Could it be something to do with financial risk in terms of pure central bank interventions or whatever? We can take a look at interest rates and have a look at things like that. And we can come up with a narrative that might fit the scenario. Actually, sometimes the narrative works really well and the obvious becomes a reality. And other times you can be correct on the price outlook, and the narrative that you thought would cause the price development isn't the narrative at all. It's something completely different. The price development that you expect, though, still unfolds. So that's a learning process. I mean, a good example at the moment is in the way in which the pandemic sell-off occurred. Because at that time, we could see that the markets were in trouble as they approached the highs towards the latter part of 2019. And we could already see that there was going to be a shock development with price action moving down. We didn't know what that would be at the time. Even when the pandemic first started to be talked about, you know, people started thinking about a contagion of it. But we didn't know for sure whether the pandemic would result in the type of price development that we would see. But that's how it's happened. Nowadays, if we bring that sort of more up to date, I mean, you can also build development and fundamentals around what we're seeing today. Because here we are seeing the Federal Reserve and other central banks around the world in a process of catching up with inflation to try and stem inflation from rising any further. It was quite obvious from the inflation pop model and the inflation pop model that I've presented just now that inflation was going to eventually rear its head. It was just a matter of time. And yet the central banks failed to recognize those warnings, which is remarkable, really, when you consider that, you know, they've been pumping money, you know, into the financial system, even to the point where, you know, we've seen huge money supply flows increasing and government debt increasing. But it was, you know, I mean, Greenspan, the ex-Federal Reserve chairman, has said for years, oh, well, at some stage inflation will come through and gold will go through the roof. Okay, he was right about inflation, wrong about gold. But at the same time, you know, it doesn't take a lot to figure it out. The problem now is that we've got central banks who were very, very late responding, and now they're probably going to over-respond before year end. So that's probably something which is up for topics of discussion. But we can see the way in which the fundamentals are trailing behind some of the price action. And these days, people are getting very astute about models being priced in, you know, prices running ahead of the fundamentals and being priced in. And a good example would be tomorrow when the Federal Reserve come out with their interest rate decision. Okay, we know that it's going to be 75 basis points. I think that's done deal. Then it's a question of, there's a 25% probability at the moment They increased by 100 basis points. But when we take a look at the short-term price development in some things, we can actually see that there's going to be, around the news flow, there's going to be there should be a very strong upward movement in commodities like copper and oil, and also on stock markets after the announcement tomorrow. We can see that in the short-term picture.
Peter, sorry, just to interrupt you for a second. Yeah. That was actually something that I wanted to ask you about. When we get these announcements, why are they sometimes, positive for the markets versus negative for the markets at other times when we're getting the same, in reality, the same announcement of a 75 basis point hike?
Well, I think this just goes down to the fact that I know in modern times we're taught to look at the fundamentals, the news flows, and extrapolate that way. But markets aren't really like that. I mean, I first saw major dislocations between fundamental events and commodity prices when I first started my career working on the London Metal Exchange floor back in the late 70s. And my job was to really assimilate all the data and ensure that the senior dealers at that time were really up to date, so they can assess what their trading book should be like. Mm-hmm. And of course, I was intimately going through a lot of information, which was ultimately, you could discard. But because I was assessing so much, I could see that clearly only a fraction of the fundamental information would really work. Most of it could be discarded. And sometimes even the most important information, like an earthquake in Chile, wouldn't necessarily send copper prices up. Mm-hmm. Sometimes we saw the copper price go down. Why? Because it was already in a terminal phase of a preceding uptrend when the earthquake occurred. And it was a point of, buying the rumor, selling the fact, because as soon as the earthquake came out, there might have been a brief flip up to extend the final phase of that uptrend. There were no more buyers left. The buyers had already, exhausted themselves. And naturally, the price declined afterwards. So, you have to really understand that there's a bit of a science behind price prediction and determination. Mm-hmm. I don't know of a better model than the Elliott wave process to really understand it in that context, because then you can see whether or not something's already priced in or not, whether it's going to react to the news or do something completely opposite to what it should be doing. And this is a good way to assess it. And I think tomorrow will be an interesting example. If I'm wrong, you don't have to invite me on your show again. But I'm pretty confident that sometime tomorrow, a lot of this rate increase is being priced in already, mm-hmm. because we're coming into some terminal patterns on things like copper and oil, and they should start to turn back up. So I'm quite interested to see how this plays out tomorrow, for example.
Yeah, absolutely. And that's why I find this stuff so fascinating is, speaking to people on both sides of the aisle that go purely fundamentals or purely technicals, it's interesting how these both correlate. And this seems to be a relatively, from both sides, this seems to be a pattern that a fair amount of people are agreeing upon.
Yeah, I think one of the two other things is there's some good tools to the trade that one can use to try and assess things. I mean, if you're using Elliott wave even in its basic format, that's a good thing, because you'll get some idea of where trends are developing, and when they hit news flows at certain juncture points, how they might react. But I think, just recently, a couple of investment bank surveys have come out. One from, one which is from Bank of America, Merrill Lynch, where they show actually that, the most crowded trade of any asset class is long dollars at the moment, which is interesting in itself, mm-hmm. mainly because I think the dollar's is approaching a major peak. So that's from a contrarian standpoint, when you get extremes like this, generally speaking, the market is in its final phase. Mm-hmm. So you need to check using maybe something like Elliott wave to see if you think the trend is coming to a terminal phase. So that's one key point. The other thing is that when the CPI news came out last week in the US, and we saw the core rate jump to 6.3%, that was a big surprise for the markets. And you saw the S&P 500 dump, and you saw commodities drop as well pretty hard. And I think the reason why that was particularly was certainly a surprise for the market, because they didn't expect the core rate to jump so high. The underlying headline inflation rate was still below the 9.1% level that we saw in June. It was just the core rate that came as a surprise. But during that time, afterwards, there was about $8 billion worth of put options being bought. People started to panic. And on a scale, certainly both in the US and Europe, and in Europe, there's been $83 billion of outflows in the capital markets this year, certainly in equities so far this year. And there was another 8 billion outflow last week, which coincided with the CPI news. So it looks very much as if the short-term picture is very oversold in asset classes. And we can see that in things like copper. Let's have a look at copper prices, just to give you an idea, and then we can have a look afterwards at maybe some of the precious metals, because they're in a different sequence altogether. Mm-hmm. But the copper prices bottomed in July, and they're in a case of moving up over the next month. This is LME 3 months copper prices, by the way, and these price movements need to start to push on upwards. So we're going to see a definite risk on phase over the next month or 6 week period. Mm-hmm. And this is really going to start pushing up. So I think the oil price as well is also another key factor. This one is ready to start pushing up to about $104, $105. And so this is why I think Wednesday, tomorrow, is going to be such a big day for these assets. And these are two key commodities which are already showing signs that they're ready to start pushing up over the next 5-6 week period. I think that's really fascinating. This, of course, is relatively short term. So then I think that we have to start maybe thinking a bit out what's going to happen for the remainder of the year. But this is just a good example of how the fundamentals are being assessed around the news flow.
Mm-hmm. Yeah, and of course, energy is such a big component of the CPI and the inflation that we've seen. So we need to, get a real good handle on what is going to happen to energy if we have any hope of understanding where inflation is headed, if it's going lower in the medium term, or let's say the short term versus higher in the medium term, right?
Yeah, absolutely right. I mean, the thing is that the energy prices have pulled down since March. As you can see here, crude oil coming down from 130.50. And I think after this corrective rally, it's going to drop down to at least $54, $55 down. Can you see these targets down here? Mm-hmm. These ones down here. I think that's where we're aiming at. I think probably it's going to take another 4 or 5 months to get down there, but it could be shorter time frame, which pushes us a bit into the end of the first quarter of next year again. But that's where the next price development is going to occur, and that will be really good for us to ease back off the inflation model a bit, because I think we're due for a correction. I think the daily chart shows that we've got to get down this year to this 54, maybe even lower, down to these price levels before we can start moving back up again. Mm-hmm. So this decline that's coming down in, say, crude oil is a bit like the chart I showed at the beginning with the CRB. This decline here, this is basically what we're looking at here. Mm-hmm. And once this development downside has occurred, let's say moving into a close of the first quarter of next year, once that's completed, then we're going to surge back up again. And that's when oil starts to turn around from these numbers and we start to go into even higher highs. And I think, maybe I just switch here, but if we want to take a look at crude oil on a monthly chart, once we've traded down here, we're going to go up to something. I think we can get up to over $200 for crude oil. Mm-hmm. That tells you a little bit about really what's going to happen for the remainder of this year and a bit into next, and then how that development is going to ignite another bout of inflation. So from that, we can easily see, that the Fed is going to have a really tough time because they're still running behind the curve. They're overreaching at the moment, probably will do by the end of the year.
Mm-hmm.
And then we're going to, and of course, these price levels are forward running. So by the time they recognize that maybe oil prices have come down considerably, they're going to start easing back at a time when this is ready to kick off and go up again. So unless they start getting forward thinking, we're going to see a very big dislocation between the fundamentals and the way that's flowing and the way that the price action is actually developing.
Mm-hmm.
And I think that's the big problem. And that's going to be a narrative that's going to continue for the next couple of years, I think.
Yeah, them responding and overreacting, but always seeming to be behind the curve seems to be, I hate to say it's something that everybody agrees on as well.
Yeah, I think it's fairly obvious. And the question is, the only way that the Federal Reserve or other central banks are going to be realigned is if they are a little bit more forward thinking. Mm-hmm. But they're always reacting. They're not being proactive. They're just reacting all the time, unfortunately. And there's no reason for them to change that because their model's not changing. I have to say that there was a study that's just being sought out by the European Commission on behalf of the ECB, which says that maybe they need to reflect on different modelling. And I think even the Reserve Bank of Australia has come out recently with a similar statement to say that they are too saying, well, our models for assessing where the economies and interest rates are going are not working. We need to reassess our modelling.
Yeah, I know. Powell has said we didn't get the inflation model right, but there's no way we could have predicted the components that went into it.
Well, yeah, and I don't think they will find the components that go into it because they're just looking at the wrong different things. I mean, they're just they're not really equipped, let's say, to have a strong forward prognosis because they're looking at spreadsheets all the time. Mm-hmm. And that's not really going to do the job, unfortunately. It's just a linear form of extrapolation.
Driving using the rearview mirror.
Yeah, you need something which is more in the non-linear stage. If they had a computer genius in the background who was actually running a non-linear modeling, he might come up with some sort of fractal sequence that would give them some idea of where things are going to. But I mean, ideally, that would be the Elliott model. But there might be some other way of creating such a thing. But they don't, and they won't. So they will always be behind the curve. So the way that the price development is working alongside the fundamental issues and the backgrounds is quite an intriguing aspect from my side because we're continually watching the news flow, how that's interacting with it. This is a very obvious stage of things. If we start coming down to looking at key commodity prices, we know there's not so much lagging behind because there's not so much intervention. So here you've got to be a little bit smarter because you've got to then sort of decide whether or not, the weekly net inflows and outflows in stockpiles of, say, crude oil are going to affect things or not. The problem with things like that, with inventories in crude oil and other energy products, is that they can suddenly go from a negative to a positive in very quick succession. And leave you straddled with a position that doesn't really suit what you originally intended it for. Whereas if you're trading metals like copper on the London Metal Exchange, it's very difficult to move around the LME stocks. It takes years to see a movement from negative to a positive. And generally, when they do start a trend, they last for quite a long time. Mm-hmm. So you've got to understand that the fundamentals are very different for different commodities, and you've got to play your specialist game if you're going to rely on that.
Mm-hmm. And of course, speaking about copper and LME inventories, of course, a good friend of yours, Simon Hunt, explained quite a bit about that to us the last time I had him on a couple of weeks ago. So, that's an interesting point that you bring up because there's so many things to consider there, and then if you tie in those fundamentals with these technicals, again, this paints a really interesting picture to me. But Peter, has the dollar strength really caused part of this decline that we've seen, considering that we price all of these goods in dollars?
Well, that's a very pertinent question, especially useful to compare maybe the dollar index with the performance of something like gold and the precious metals, which will bring us into that area of discussion now. Because, I mean, the dollar itself is quite extraordinary in the way in which its long-term development is occurring. First of all, we've got to understand that here's a long-term look at the dollar index. And one thing you have to understand is that, well, actually, we've got something even longer term than this. Let's go back a bit to the dollar index. The most pertinent point of history is this point here, the American Civil War, 1863, this period, 1864. The dollar index was at a low at that point, and since then, it's evolved into a classic Elliott process of its uptrend. When we saw the CRB index earlier, we described that the supercycle in commodities was developing into 5 price swings. That's how we define a trend. Here you can see 5 waves developing in the dollar from 1863 forward. It's moving up into 5 waves, and eventually it peaked in 1985. This is a quarterly closing price level. It was higher on an intraday basis. But the key factor is that 5-wave developments occurred, and you need a 3-wave correction to the downside in order to augment a satisfactory correction thereafter. And now we come to how that develops down from this intraday high at 164.72. This is the 1985 high. It's taking the form of what we call a zigzag. It's 3 price swings. The initial price swing comes down here. Then you go through a consolidation pattern, which is everything to the which has happened afterwards. It's pretty much broadly in a trading range. And then eventually this downswing here will be repeated here. So you get 3 price swings down, an initial downswing, a sideways broadening pattern, and then another decline. And that will be the completion of the satisfactory correction to that huge uptrend which developed from 1864. This gives you a very good historical background to what's going on with the dollar. There's a certain upside limitation now to the dollar and its trend, and I think it's topping out. Ordinarily, from the pattern perspective, if anybody's listening in or watching, they might recognize this pattern to be part of the flat pattern family. We've actually labeled it as a running flat because this sequence up from the pre-financial crisis lows is developing in 5 ways, but it's not actually breaking above the initial swing up for wave A at 121. We think it's actually going to fall short. Technically, if this was an expanding flat, it would trade slightly above 121. But looking at the cross correlation of other G10 currencies, I think particularly some of the commodity currencies like the Canadian dollar, Aussie dollar, Norwegian kroner, I really don't think the dollar's got much left on it to the upside. So this should be starting to turn around pretty soon and start heading down. And that's going to be quite significant. What possibly could turn the dollar down over the next several years? Now, again, we don't have a crystal ball, but we can hypothesize. I wouldn't say that my hypothesizing is necessarily the correct outlook, but obviously it should make logical sense. The only thing that's going to send the dollar down, perhaps maybe in the initial stage, is if inflation has an interim peak. That might be possible. Mm-hmm. The only other alternative is that the dollar is, and I think this is where Simon may have talked to you about, because I think a lot of this is what Simon Hunter's been talking about. And that is that there's a big push away from having the dollar as a reserve currency in the world today. And
well, I was sorry to interrupt, Peter, but I was going to say maybe that can be coupled with 2 things. One of which you just mentioned, right? Not necessarily the loss of the only reserve currency, but part of that dollar's reign coming to an end, that end of an era for the world using dollars exclusively to trade. but also maybe a loss in confidence in the dollar after the Fed, goes too far too many times. Is that possible?
Yeah, I think that could be the case. I mean, at the moment, you're getting headlines like "King Dollar" on the front of magazine headlines and things like that. So, I mean, the dollar is king. It's certainly at the moment. Will it stay that way? I don't think it will. Certainly, from a pattern perspective, we can see it's in a terminal phase. But whatever triggers it, I think the obvious would be for me that we're going to see a quantum change in the way that the dollar's being treated around the world. I think the whole expression of lockdown and COVID pandemic levels and other countries around the world, including other producers like oil producers like Iraq, are seeking to hold other currencies other than dollars at the moment. And so, of course, is Russia, because they've been blockaded, if you like. And China certainly has been accumulating gold reserves for a long time. Why are they so specifically accumulating a lot of gold? I mean, if you want to stabilize your own currency and make it internationally acceptable, you've got to offer something as a backup. Gold might not be, it might not be an only gold standard that emerges to back a currency up like the yuan or the renminbi, but a combination of different commodities as well, which I think Russia is leaning towards. And all of this can weaken the dollar going forward. It's not evident at the moment, and that's why it's particularly interesting to see what structural changes, geopolitical or otherwise, might be occurring at the moment, particularly when we can recognize that this is in a terminal phase. And I think there's a good reason to think it is in a terminal phase, because one of the things that we can now dovetail into is gold, because gold has been declining, particularly since March, but also from that August 20 high, which was double tops out at 2070. And gold has really been driving down since March, particularly because the dollar's been moving up since March. It's not really rocket science, and anybody can figure it out. So when we take a look at gold prices, we can see that over the long term, we've got actually some pretty exciting swings upcoming. This is our long-term trends up. I think last time you and I got together, Tom, I think I probably showed this chart anyway, and it was updated in our mid-year report to show that gold was still under pressure coming down. But there's a very distinct Elliott pattern process here of 5 waves up from the late December 2015 low. You can see it's moving up wave 1, 2, 3. This is basically wave 4 from the August high here. This is August 20 high. And this is coming into a terminal phase now. So gold hasn't got a lot left to do on the downside. And then in the next 2 or 3 years, we're going to get this type of development to the upside. Now, we've got some time zone around April 24, but I wouldn't be surprised if this lengthens itself out. So I'm not fixed on 2024 as an eventual top. We could be lengthening the time frame out by at least a couple of years even. It's possible. But one thing's for sure, gold is in a terminal phase at the moment. Now, if you've got this negative correlation between gold and the dollar, and gold is bottoming out, there's a very distinct pattern here. The conviction is very high that we're going to be bottoming out pretty soon, and gold's going to be turning back up. What do you think the dollar's going to do?
Comparatively go down, yeah.
It's going to have to go down, isn't it? So, again, it's not rocket science, really.
And interestingly, putting together a talk I did last week, if you look, the dollar was up, I think it was something like 15% over this year since March. And yet gold was only down, let's say, just over 5%. So comparatively, it was actually relatively strong compared to some of the other markets that have declined much more.
Well, gold since March has dropped, 19.5%?
Is it 19?
Yeah. I mean, gold in March was 2070, right? And we're now 1664 gold.
Right. Okay. I was going from January.
Okay. Well, I mean, where was the dollar index in March? So let's have a quick look. Go back to that a second. Well, March, yeah, okay, March this year, we're roughly around these price levels here.
Mhm.
So we've got 19.5% down for gold. We've been to 110.80 and 97.90. So the dollar's up 13% versus gold down 19.
So in that case, it's a much higher correlation than comparing January to January.
Yeah, I mean, the dollar's up 13%, gold's down 19%. So gold effectively, on a direct comparative note, is underperforming, isn't it? Mm-hmm. Silver's had a much bigger drop as well. But interestingly, I don't know whether you've picked this up just in the last, since the last few weeks, is that silver has already bottomed, and yet gold is still trying to decline, and that's a very significant aspect because silver doesn't ordinarily outperform gold. You know, I'm talking about not on an intraday basis, but over a week by week basis. We've had 2 or 3 weeks now where silver's outperformed gold, and that's really interesting because silver only outperforms gold during an uptrend. It almost never outperforms during a downtrend, silver. So this is again another indication that we're going to see a very strong directional change on gold pretty soon. Gold hasn't got much left to the downside. If, for example, on Wednesday the Fed come out with their interest rate hike, whether it's 75 or 100, doesn't matter, basis points, I wouldn't be surprised if gold suddenly drops into our target range. We've got 1630 as one target range, which is only $30 below where we are. If you look at a daily chart, just go forward a bit. So 1634 and 1631 is an obvious target. The next number is 1595, 1600. Mm-hmm. Somewhere down there, gold should bottom, I think. And I wouldn't be surprised if it bottoms after the Fed announcement. Because silver at this stage is really looking good. I really like silver. And silver looks a bit like bottoming already at 1754. Here we go. And this entire downswing, again, from this 2020-21 period has bottomed here. We've got very close to a Fibonacci target if we extend like here, down here by 61.8. This is where we thought that silver should try and test this level. It came up a little bit short, but it's immediately rallied last week, the week before. And this is already showing signs of outperformance. If you look at the gold-silver ratio, one of the things I think that's going to be very evident going forward is that silver will outperform gold in the next big bull market. So when the dollar eventually declines and turns down, and we get gold beginning that next move from whatever, 1634, 1600, beginning that next move up to 25, 2700, I think that next bull market, we're going to see silver way outperform gold because the gold-silver ratio, which is what you're seeing on this graphic now, has already had a major directional trend change. Here was 126. That basically means 126 ounces of silver to 1 ounce of gold. And when the spread narrows and drops down like this directionally, it means that silver's outperforming. Because here, for example, which happens to be August 20 when gold topped out at 2070 and silver topped out, the ratio contracted to 68. So you only need 68 ounces of silver to buy 1 ounce of gold. So it's strengthened. Since then, we've gone up and down and up. This is an Elliott expanding flat pattern. It's completed last month or earlier this month at 96.55. And you can see the reaction downwards from the predetermined levels that we had. So this actually suggests that silver is already bottomed. The underlying silver bullion price has bottomed. We might see a bit of a correction here up in the next week or two before it returns down. But basically, the longer term outlook is incredible. Over the next few years, certainly it looks very much as if silver will vastly outperform gold in the next bull market. So I think that's really interesting, especially for the gold bugs.
could be a sign of, like you say, starting to lead and outperform gold only in an uptrend, right?
Silver tends to only do that in an uptrend. Yeah, I mean, this contraction in the spread, in the ratio, wouldn't occur if silver was in a downtrend. It's fixed to basically directional trading in the underlying commodity. In this case, a spread contraction would mean silver's in an uptrend. So that's really, really important. And certainly in our mid-year reports, we also talked about platinum going forward will outperform silver. So, for those out there who really want to be involved in precious metals, especially if the dollar's going to be declining, and certainly the analysis suggests so, silver's going to be better than gold, but actually if you want to really outperform, you should be buying platinum. Mm-hmm. And if we take a look at, say, something like the spread between platinum and silver, here's the platinum and silver ratio. Now, interestingly enough, we have the platinum silver ratio. It's already bottomed into the pandemic low here at 33, but it's going to widen out to at least 56, 57. And we've got long-term silver going up to about at least $55, maybe 60. Mm-hmm. Let's assume the very least $55. You multiply that by 57, you're going to get a target of about 3,200 for platinum. Mm-hmm. And if we take a look at platinum over the longer term, well, here we are, 3,200. And this is completely independent of the ratio analysis. It's based on an expanding flat pattern, a B wave, a bit like oil over the long term. Here's the long-term peak, and everything to the right of my vertical line there, to the right, is an expanding flat. And this is wave B, which necessitates a move into a slightly higher high. Here's a Fibonacci 23% ratio. And it just so happens to come out to 3,200. So you've got the ratio, a separate ratio analysis, and the applied Fib price ratios of that, very much confirming that platinum's going to be a very, very big outperformer going forward. Mm-hmm.
So, Peter, when you're thinking about this ratio analysis, does that make you want to take a position only in platinum, or would you spread out between, let's say, silver and platinum?
Well, I mean, if you asked a fund manager who was trading equities this same question, he would really start to say, well, we need to outperform the index. Mm-hmm. And so they're going to select equities which have the most potential. That you might say, well, they might have an answer to say, well, we're going to spread it, because we don't really know for sure. Mm-hmm. So we'll probably put the portfolio maybe leaning more towards technology stocks. We think they're going to outperform in the next uptrend because they've got a historical higher beta, and then we might start choosing some selections within that sphere, certain industry groups or whatever. And then we might start to pare down on some others. So, a portfolio manager would think in that way. So he might say, well, okay, I like gold. I know gold, so I'm going to buy gold. I don't know so much about silver, but if the analysis tells me it's going to outperform, I'll buy a bit of that as well. Mm-hmm. And it depends on each individual, really, how they approach it. If you want maximum leverage and you have a conviction about something, why should I buy an underperforming asset when I know the one that's positively correlated is going to be vastly outperforming? Mm-hmm. But it depends on your conviction level and how you want to spread your own portfolio, really. It's a personal choice, isn't it?
Absolutely. So, exactly in that vein, what do these moves mean for the miners as well? Typically we see the miners move dramatically more than the metals with more volatility as well. So could it be a good idea to look at, stepping into some of the indexes of the miners at that point where we see these cycle lows?
Yeah, definitely. I mean, when we initially saw the lows in 2016 on some of the miners, and the GDX was a good example. I mean, you're right. The equities, the gold miners, actually performed much, much better than gold bullion. It was very noticeable in the GDX. So let's have a look let's go to the weekly chart, and you can see that the initial move up from the end of 2015, early 2016. I mean, we went from 1240 to 31, 32, whereas gold bullion really underperformed during that phase, and this gave us huge outperformance. And I think that we'll still see outperformance here. I mean, if we think that gold would go to, let's say, what do we say, gold's going to be going up to something like 2,500, let's say, on a conservative basis from 1,600. So we're talking about a percentage gain of about 56%. Here on the GDX, I think we've got even higher targets over the longer term. We're going to get up to about 116 minimum. And let's say we're bottoming around now, around these price levels, so let's say 23.5. That's going to be around, well, it's almost 4 times multiples, isn't it?
Mm-hmm.
So it's quite clear that, you know, you would probably want, in terms of performance at least, you definitely want to be long the gold miners as opposed to the underlying bullion.
Mm-hmm.
I mean, on those percentage gains, why would you buy bullion at all?
That's a fair point. I guess it depends what job you see that serving within your portfolio. If it's a safety hedge instead of just being trying to create alpha, then yeah, it just depends which way you look at it, right?
No, exactly. I mean, if you felt that it's worthwhile buying gold bullion, you know, maybe gold ounce coins or whatever, you can physically take those. They're very tangible. If all hell breaks loose and some geopolitical thing, or if suddenly
you can't be turned off with a mouse click.
That's right. Then you've got something tangible, you know, to hold in your pocket, you know. So that's a good thing. It's one thing. I mean, I was always thinking about that, you know, buying maybe platinum coins as opposed to gold. But if I went in the street and showed you maybe a platinum coin and said, hey, look, this is vastly more valuable than a gold coin, and I showed it to you, would you be able to know that? Would the average man know the distinction between a platinum coin and a silver coin?
I think I was just going to say, I think the average person would just assume that it was silver and assume that it's far less valuable.
Yeah, I mean, I would probably say that that's a true outcome. So gold may still have a value if you want to have something tangible, you know, because most people probably can recognize gold. In the old days, we used to bite it, didn't we, to check if it was gold or not. Mm-hmm. But yeah, it's tough to distinguish between a platinum coin and a silver coin. So you might, if you're going to look at tangible items rather than trading the alpha on an index based or whatever, you buy gold bullion for that reason, or coins.
Mm-hmm. So maybe, Peter, just before we wrap up, could we look at a couple of the stock market indices to see your outlook on those over the next year here?
Yeah, I think actually it's probably worth me pulling up a chart from our annual report first of all, so that I'm not going to scare everybody, because one of the things which I think was really important when we published our annual report, which was last December. You know, we said that this year was going to be a really, really big down year for equities. Mm-hmm. And we had a pretty good idea that the economy would start to contract, but it wasn't obvious at the time. And this comes back to our discussion we've had a bit earlier when you said, well, how do you dovetail with the fundamental news? You know, how does that picture, can we derive some sort of narrative story behind the results that we're getting from an Elliott prognosis? And sometimes it's difficult, because I had lots of discussion with hedge funds and tier one banks here in my office around December last year when we first published the report, because we were expecting a very big downswing. And at the time, the consensus estimates for the S&P 500 through all the investment banks and the broker-dealers last year was, I think 75% said this year would be a 5 to 10% gain across the year. And anybody that sort of said it would go down said it was going to go down by 5 to 10%. That were the brave ones. And no one said it would drop more than 20%. No one, zero, in the survey that we saw. And that was very explicit. But what we did identify, and the reason why we said that this year was going to be a big down year. Okay, this chart was dated December 19th, 21, and we were coming into a major high for the S&P, and we said the price would start to drop really severely this year. The reason behind that really was the fact that when the pandemic low occurred and started to rise, we saw this as the final phase of the secular bull uptrend, which really began from the financial crisis lows. And it ordinarily would develop into this very dynamic 5-wave approach, which the Elliott wave pattern model implies. But we'd seen a 3-wave dynamic, a 3-wave pattern develop up into the highs. And that told us specifically that this wasn't going to develop in a normal way. It was actually going to develop in what we defer as a diagonal pattern, because this is the specific characteristics of a diagonal, which is the 3 price swings up here. And the diagonal pattern is consisting of 5 waves, but in order to get the actual pattern working, it's the dimensions and the proportions correct, it requires the second wave to be a very deep sell-off. Mm-hmm. And so this was the forecast last December. We didn't know what the fundamentals would be at the time. We created a sort of a narrative around it, but we said this is up for discussion. Mm-hmm. And since then, this is what the S&P looks like today. It's that same diagonal pattern is showing here. But we've obviously dropped 20% so far, a little bit more. I think the NASDAQ was down, I think about 30%. But we've dropped down here. We've gone through since June a bit of a counter trend rally, but we're about to begin this next sequence down again. So I'm afraid it doesn't look good over the next 6 to 8 months. It looks like the market's going to, well, I say 6 months into the end of the quarter of next year. I think that the market's going to drop again quite significantly. Mm-hmm. To follow the same model that we had back in December last year. So it's actually working out perfectly. The model itself is actually really running very well. When we take a look at the very short-term picture, which dovetails to what I said earlier about the Fed in this week, it looks to me as if we're going to get, before we start heading down in a big way, we're going to get a counter-trend rally up here. So I think the S&P is somewhere forming a low. It's either right now forming a low, getting ready to push up, like copper and oil, which we looked at earlier, or it's going to start from maybe, I think the maximum level I've got is 37.80. If it were to drop down there, if the Fed surprised and put out 100 basis point increase, mm-hmm. S&P might get really rattled by that, and it might have a flash sell-off. So watch the 37.80 number. That's a very important fib price ratio level. But I think it's going to snap back up again afterwards. And for those that haven't already, adjusted their portfolios accordingly, you can do it then, because after this rally to the upside, we're then going to resume this big decline down here, mm-hmm. and that's the really tricky point. I think whilst though the S&P runs up here, this is about a 13-14% rally. That's going to be sufficient to get oil up to 104.75, which we saw earlier. So it's this move up, I think, to 104.75, and that also plays into the copper price, which we also looked at earlier. Getting up. This is the LME 3 months price, getting up to these sort of price levels. Mm-hmm. So this is going to be a final hurrah rally before we have trouble again. With prices coming down afterwards. But that's a bit of a snapshot of what I think is probably going to develop on the S&P.
Mm-hmm. Yeah, again, it's so interesting to look at these structures and to think about the broader, let's say, implications of that, and then also the broader fundamental picture that we often talk about on the show as well.
Yeah, I think from what I can see, which is a bit counterintuitive, there's a negative correlation between stock markets and yields, interest rate yields. This has happened just recently. In August, the Treasury yields bottomed, and they started to move back up to where they are today, back up to the old highs that we saw earlier this year. Meanwhile, stock markets have dropped down, and that negative correlation is something that we're not used to. In a deflationary environment, those two asset classes would move in the same direction. Stock markets go up, yields go up. Stock markets go down, yields go down. But here in this particular inflation period, they're negatively correlated. And that's right, because you hear that, well, if the Fed are going to hike rates as much as they have, that's a bearish aspect for the stock market, right?
Mm-hmm.
Makes sense. And that's the way it's certainly portraying. So if we think that the S&P is going to make a low this week around the announcement and then start to push up, you'd expect yields to fall back downwards.
Right.
And we can probably just take a quick look at Treasury yields. Yeah, they're coming into the completion of 5 waves up from the August lows at the moment. We tend to think there's going to be a natural balancing correction downwards after the figures are announced. So once the announcement comes through, we think the stock market should rally and the yield should drop in a correction. Let's see if it works.
Mm-hmm. Well, it'll be interesting to see how all of this plays out, Peter. And I really look forward to reconvening with you to see maybe how your outlook has changed, maybe if it has solidified your resolve in how you see these patterns.
No, great, Tom. Yeah, no, thanks very much. It's been good to air some of these things with you, and yeah, I just hope it gives some insights. And well, let's see how things develop. And so far, so good. It's working out pretty well, I think, and very happy with the way, particularly gold has dropped down this year, and we've seen the dollar push up, and also, in particular, the way that the interaction of the stock market's playing itself. I mean, that's really a good score. So let's see if it continues the other way. Yeah, let's do so. Yeah.
Mm-hmm. Peter, do you have anything else you'd like to add maybe before we wrap up?
Well, I think one of the key issues really is still this inflation idea. Here you can see that in terms of interest rates, we haven't quite finished interest rates moves up from the pandemic lows. This has a 5-way development to the upside. So I think one of the key points just to finish off with is the fact that once this short-term correction to the downside in yields has finished, and we start to see that flip to the upside on the S&P, when the S&P starts to drop next time, that means that yields will continue to move to the upside. And of course, that does therefore translate into the idea that the Fed will just keep going with their interest rate incremental increases. And I think they probably will end up overreaching in the end. Mm-hmm. You can see here the 10-year yields, we've got a target of about 466. I saw some investment banks mention last week that they might even start thinking about upping their forecast to 5%, which is a nice round number for some to aim for. So I think really just to finalize things, I would say that overall the markets are giving me the impression of an orderly process. We haven't seen too much deviation from last December's forecasts. So if you're out there and you're thinking, well, the market seems a mess to me, I would just say that, perhaps create a little bit of Elliott wave space for yourself, because I think this will give you a few restful nights sleep.
Mm-hmm. Yeah, and help you maybe position a little bit better, right?
Yeah, I think so. I think that certainly you get an idea of what is possible and what is not, and that's also very, very important if you're an investor and you're approaching this from whatever time frame you're trading.
So for any listeners that would like to, more of your materials available at wavetrack.com and of course on Twitter at ElliottWave_WTI, right?
That's correct. Yeah, thanks very much.
Excellent. Peter, thanks so much for your time and sharing so much of your knowledge with us today.
Great, Tom. Thanks very much indeed. I appreciate the airing.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.